Hello everyone and welcome to my channel. For those who don't know me, I mainly invested in Canadian dividend stocks and share my investment journey in this channel. If you are interested in these topics, consider to subscribe my channel and turn on the notification. Today, the stock we are looking at is Canadian Utilities, a company that is very likely to be the first dividend king in the Canadian stock market and should not be ignored if you are a dividend investor. So first, what is a dividend king and why should dividend investors care about that? Well, one way we can classify dividend stocks is to see how long they keep increasing their dividend. As dividend investors, we care about dividend, and if a company can consistently increase their dividend year by year, that will benefit our investors as well as make us form a stronger confidence in the company. Canadian companies with a long history of dividend growth generally shows a strong business model and robust financials. A long dividend increasing history also tells us that even during the recessions, those companies still not stopped increasing dividend payments. And if there is a recession coming in the future, we are more confident in believing that they will still do the same thing. Based on the timescale, we can classify good dividend stocks into three classes: a dividend achiever, a dividend aristocrat, and a dividend king. A dividend achiever is a company that has increased its dividend at least 10 years in a row. A dividend aristocrat is a company that is part of the S&P 500 and that has increased its dividend at least 25 years in a row. And lastly, a dividend king is a company that has increased its dividend at least 50 years in a row. And for the company we are looking for today, Canadian Utilities has shown a 48-year track record of increasing common share dividends. This is one of the most beautiful graphs for a dividend investor. As we can see, Canadian Utilities has been increasing their dividend year by year since the 1970s. And if we want to live on dividends in the future and become financially independent, Canadian Utilities is really a good choice. So what does Canadian Utilities do? Canadian Utilities is a diversified global energy infrastructure corporation. So their business mainly focuses on utilities, energy infrastructures, and retail energies. And if we look at their earnings, we can see 95% of their earnings comes from regulated utilities, which means their end earnings will be quite safe and stable. Because a regulated environment means there is very low or nearly no competitors. And I have also talked about regulated utilities in my video about Algonquin Power and Utilities. If you are interested, you can click the card above. The market cap of Canadian Utilities is around 9 billion and it has a beta value of 0.5. So beta value tells you how volatile the stock is. Usually a beta value higher than 1 means the stock is more volatile than the average. And if the beta value is smaller than 1, then that means the stock is less volatile. The PE ratio of Canadian Utilities is around 26, which is not too high, but still is over 20. And the forward dividend and yield for Canadian Utilities is $1.6 per share, and the yield is around over 5%. So what we need to know here is that Canadian Utilities actually pays an annual dividend, which means it will only pay you dividend once a year. And now let's go to the balance sheet and calculate the current ratio of CU. So the current ratio is calculated by using the total current assets divided by the total current liabilities. If the current ratio is higher than 1, then we can say this company is in a good financial status. And if the current ratio is over than 2, then we can see the financial status of this company is extremely good. So let's see how Canadian Utilities performs. So here we use 1559000 which is the total current asset, divided by 856,000. And we get a current ratio of 1.8. So we can see this company is in a good financial status. So far, everything is pretty good with Canadian Utilities. It has a very high dividend yield. It has been increasing its dividend year by year, and it's very likely to be the first dividend king in the Canadian stock market. So, is there any downsides of CU? Of course there are. So first thing, we can see the stock price of Canadian Utilities is actually quite stable, which means probably you will not enjoy much capital gains from this stock. So it's just kind of changing between $30 to $40 in the recent 10 years, which means we are purely looking at the dividend of this stock. So what I suggest is that if you already have a lot of money and you want to be stable and want to enjoy the high dividend yield, then Canadian Utilities is a good choice. However, if you are just getting started as me, you want to explore in those good dividend stocks, but at the same time, you also want to have some capital gains from your dividend stock, then probably you don't want to hold a large portion of CU in your portfolio. Another concern is that the payout ratio of Canadian Utilities is pretty high, it's over 100%. So if you remember, usually we want the payout ratio to be below 75%. However, I don't consider this as a big problem in case of Canadian Utilities. The first thing is that the reason that we want to keep the payout ratio below 75% is that first, we want the dividend to be consistent. Second, we want the company to keep some money in their pocket so that they can keep growing their company. However, we have already seen that Canadian Utilities has a really good record of paying increased dividend in the past 48 years. So I don't think if the payout ratio is pretty high for 1 year will result in an unstable dividend. Currently in my portfolio, I hold 3 shares of Canadian Utility stock, and with a total value of $102.06. It takes 1.87% of my entire portfolio, and the all-time return is around 4.6%. So as I said, I'm just beginning in my investment. So even though I think this is a very good dividend stock, but I want to buy more dividend stocks that has both the growth potential as well as a high dividend yield. So for this one, I would recommend you to have some portion in your portfolio, but also determine how much you want to buy based on your current status. So if you are just starting, maybe some of it, not too much. But if you already have a huge amount of money in your portfolio and want a stable dividend, then CU will be a really great choice for you. Thanks for watching my video. If you like it, consider to hit that like button, subscribe my channel, and turn on the notification. And if you have any thoughts or opinions, feel free to leave a comment. If you are thinking about using Wealthsimple Trade, consider to use my referral link. You can get a $10 bonus after you invested more than $100 in Wealthsimple Trade. If you're already using Wealthsimple Trade but haven't got the $10 bonus yet, you can still get it by using my referral code shown on the screen. At the same time, if you want to find some place to store your emergency fund, consider using Wealthsimple Cash or EQ Bank. They offer interest rates higher than the big banks in Canada, and you will also get bonus dollars if you are using my referral links. So thanks again for watching my video, and I'll see you in my next video.